Every day I come across individuals who have a misconception about their own real estate capabilities. Now, these misconceptions come from harmless conversations with friends, family, or coworkers that I call water cooler conversations. Now, these conversations typically don't have a whole lot of evidence behind them, but they have a lasting impact on one's belief on what they can or cannot do in real estate. I'm excited to introduce a new series called Beyond the Water Cooler, where we talk to a variety of real estate professionals about a variety of real estate topics to take a deeper look and to see, are they true, are they relevant, and if so, who and in what situations do they pertain to. In this first episode, we're going to be talking to Stephen Bowdon of Academy Mortgage about the 9 steps to financing for first-time homebuyers. We're also going to be talking about some common misconceptions and even run a mock buyer through the financing process to see what they would qualify for. I chose to work with Stephen because he's highly personable in his approach and highly educational. I hope you enjoy. All right, Stephen, well, welcome to Beyond the Water Cooler. Thank you for joining me.
Thanks for having me here.
Absolutely. I think I'm really excited to be talking to you about this, Stephen, because I think this topic right here is kind of the inspiration behind this entire series of going beyond the water cooler. Obviously, both you and I talk to a lot of people and first-time buyers almost on a daily basis about this process. And unfortunately, a lot of people have misconceptions. They might not fully understand the process, and they might be just intimidated and too intimidated to pursue it. Oftentimes, especially after you talk to them, they come away thinking actually really quite optimistic about the whole thing and about what they can afford and when they can afford to get it. So having said that, Stephen, let's pop right into it. We're going to cover 9 steps of securing financing for your first-time home buyer. Then we're going to go into some misconceptions about financing. And then we'll finish off with a little example first-time buyer to see, what her situation is and what she can qualify for. But let's go into these first 9 steps. And the first one here, Stephen, is talking to a loan officer.
Yeah, and so it's important to speak to a loan officer, and a lot of people will say to themselves like, oh, I'm 6 months out, so I don't need to talk to somebody, or I'm a year out, so I don't need to talk to somebody. And I think it's extremely important to talk to somebody the second you start thinking of buying a home, so that we can help you roadmap what that financing looks like. You'll be amazed that a lot of people will say, well, I think I know I'm doing the right thing, and I'm just going to wing it. And I read a couple Google articles, and so I'm going to wing that process myself. And then the 6 months goes by, then they call me, and they didn't draw the correct roadmap for themselves. And so there are some other things. And then they kick themselves going, man, I wish I would have talked to Stephen 6 months ago just to get that conversation started and have him help me map out what that looks like. So speaking to a loan officer, just that conversation, it doesn't have to be credit pulls. It doesn't have to be all of those things. It's just a quick conversation to get that, what are your goals, are some of the questions that I ask, and try to figure out where it is that you would potentially land, and then mapping that out for you. So that initial conversation is extremely important, whether it's 6 or 12 months out, that doesn't matter. A lot of people feel like that's a thing, but it's not. So that's one of the reasons why it's extremely important to talk to somebody now.
So when you talk to these people and you put together these roadmaps for them, like what are some example roadmap activities you have for them?
Yeah, so stuff like savings, right? So they say, Stephen, I want to buy a $400,000 house. How much money do I need to save? Or I really want this kind of monthly payment. What kind of house price does that put me in? I know I'm not doing anything for a year, but I'd really like to kind of mess around on a search engine with somebody to kind of see what that's going to look like. So it's things along those lines. We might go over somebody's income. And I might say, okay, this is probably the price point you're going to be. So even just those little things like this is how much money you need to save, or this could potentially be the price point that you're in, are a couple things that people are just guessing on until they actually have that conversation with me. So it's pretty helpful.
Got it. Well, that kind of leads us into number 2, which is figure out what you're willing to spend on a monthly payment.
Yeah. And that's huge because, I always tell my clients, just because you can afford something doesn't mean you should. Mm-hmm. And so you should do it, right? So just because I say, oh, you could buy this crazy, up here, and people are like, whoa, that's terrifying. So creating a budget for yourself, looking at how much money you're spending on rent, how much money you're willing to spend each month is extremely important. Sometimes that takes looking at your financing. And so one of the things that I like people to do is, I'll have you print a bank statement, go old school on it. You print a bank statement and you take 2 highlighters. First highlighter is like yellow, and that's the must-haves. Well, if you must have Starbucks every morning, that's yellow. If you must have cable internet and a cell phone, and you highlight all of those things in one highlighter, then you take another highlighter and say blue, and you highlight all of your miscellaneous spending. And then you separate those out and you look at it. It's amazing how much excess spending someone has. You're like, I didn't know I went to Target 15 times last month. What did I even buy there? Or, wow, I really am an obsessive shopper. Or, but it really gives you a big picture. So then you can look at that and say, wow, here's the things I'm not willing to budge on from a lifestyle standpoint, like coffee in the morning at Starbucks and my cell phone and things like that. And the other one is, here's all my excess spending plus how much money I have that I'm putting towards rent. And it really gives you a really good, clear picture of how much you're spending each month, how much excess money you still have. So doing those exercises on a monthly payment and just finding out your budget, because that's really an important part of the buying process, because you never want to be outside of your comfort level. So maybe sitting down, doing some exercises like that, figuring out what a monthly payment would be, it's comfortable, that's not going to put you in a hardship, is super, super important.
Yeah, and I'll say I recently did a similar exercise that you're talking about with the highlighters, and November and December are not great months to do that with all the excess groceries and all the excess gift and shopping. So
yeah,
looking forward to seeing how that highlighter exercise works out for me in January.
Yeah,
it's a good exercise. Obviously, one of the next steps there is going to be figure out how much money you have and or could save for a down payment.
Yep. So kind of that third step is really, how much money do you have? How much money do you have access to, right? Do you have a family member that's going to give you a gift? How much is that? Have you had that conversation? If that person's expressed that they might help you out, like a family member, maybe have that conversation. Hey, we're going to start diving into this. How much money was that you're going to be gifting us? Or does your 401k allow you to borrow money from it? How much do they allow you to borrow money from? How much money are you saving each month? So really just kind of trying to get those things in place to try to say, okay, when I get serious about this, I think I could have, about 10 grand by the end of next month. Mm-hmm. Or, if I did that, I might have 10 grand saved, and I might also have a little bit of money in a 401k that I could use. So just kind of get it, looking at your financing, because, we're so busy with our day to day, it's hard to, a lot of people just look at their checking savings, but they forget about that potential gift, and they forget about that 401k they can borrow from themselves on their 401k. So a lot of things there. So just kind of sitting down, looking at your finances, looking at how much money you think you can save, so that you have that number to give to me as the loan officer. And I can take that with your income. So step 1 and step 2 of what you want your payment to be versus how much money you have. And we can really start to put into place and figure out what price point you're going to be at. Mm-hmm. So knowing how much money you have to play with is a great thing. And knowing how much money you can save, because over 6 to 12 months, if you're a 6 or 12 month buyer, that's why, step 1 is super important, because, we're going to roadmap that. So part of that roadmap would be your savings, which is the step 3 of just going, hey, Stephen said I need to save 15 grand. We're on a mission. This is how much we need to save each month. I can access this and do that. So just kind of having a grasp of how much you potentially save, how much you already have, is super important.
Yeah, and so the upfront cost of getting into a house would be, right, the down payment and closing costs. Mm-hmm. Are there any other aspects we should be considering as far as cash that we need upfront?
So up front for the lender, so the lender actually never makes you write a check until you've actually, a couple days before you're getting your keys. Okay. The only thing during the loan process that you actually have to have money for, like in hand, is for your home appraisal. We do have to have the money in place by the time of closing. So you get into contract on a house. We don't actually make you write that big check until the very end of closing, right really close to when you're getting your keys. There are some other things involved, and those are on your side of things that people have, like home inspections and things like that. But from an out-of-pocket standpoint, during the process, it's mainly just appraisals paid for, because those are independent third parties. Mm-hmm. But outside of that, they really just not a whole lot out-of-pocket expenses initially on the lending side of things.
Got it. Okay, well then let's go to number 4, which is understanding and monitoring your credit. Yep.
So it's credit is a huge thing. So we have three things that we look at when we're approving people. Not one thing can outweigh another. So we really truly have to check three different boxes. One is your debt to income ratio. So it's your income versus your outgoing bills, right? And we've already kind of talked about it. How much you're willing to spend and how much you can afford. The other one is how much money you can bring to the table. So it's assets is one box. Debt to income ratio is another box, and credit is another box. You could have $10 million in your checking account, but if you don't have good enough credit, you can't do a loan. So each box has to be individually checked. So understanding your credit, when you just mentally, you're like, I think I might want to be a buyer. Understanding your credit, going and getting a credit report. The government actually pays for you to get a free credit report once a year. And that's at annualcreditreport.com. So it's annualcreditreport.com. And if you go there, you can get a free credit report once a year. If you want to go take a step further and pay a little bit of money each month, having credit monitoring is really important. It tells you if somebody's pulled your credit. It gives you tips and tricks on how to improve your credit. Talk to people and they have no idea what their credit looks like. And so going in there and just getting a really grasp of what that looks like, and then rounding back, right? That conversation with your loan officer, that's step one. So when you do call me, you can say, oh yeah, I pulled my credit report. It looks like this. Or you might even say, I had an issue here. Well, that's part of our roadmap, right? If you had an issue, it's better to talk to me today than it is 6 months from now. I can put you on a path. We can roadmap that with you. So understanding what your credit looks like is extremely important, making sure there's nothing that's outstanding that's in collections. And there's a lot of different graphs, and that's something you can actually reach out to one of us for. If you're watching this and you want to see each thing that you do has a certain percentage impact on your credit, whether it's the balances that you're carrying on your mortgage or on your credit cards. How much are you paying each month? What percentage of debt are you carrying on those credit cards? Are you have a $2,000 credit card and you have a $1,900 balance, that will affect your credit. So there's a lot of things there that we can help you roadmap to actually improve your credit scores. So if you want something like that, we actually have some cool graphs and some cool flyers that can help people through that part. But understanding where you're at and from a credit standpoint is super important.
Got it. We'll put that link to either below or on the screen, annualcreditreport.com. And real quick, we talked about this a couple of days ago, but how does that differ from, let's say, a Credit Karma?
So when you pull, it's funny because a lot of people will say, well, Credit Karma said my score was a 720 and your guys' score came in at 700. And so you have different types of credit scores. So actually, and what most people don't understand is that, and I didn't understand this until I was in this business, that you have, different types of credit scores based on the purpose of what you're getting your credit scores pulled for. So if you have your credit pulled for a car loan, you're gonna have a different score than if you have it pulled for a credit card. And if you have it pulled for a mortgage, you're gonna get a different score than you have with a credit card. So there are some variances there depending on the type of loan that you're trying to get. They look at your past and your history of what you've done from a credit standpoint. Have you just had credit cards? Well, then your mortgage score might be lower because you haven't proved to anybody that you've had something like a big installment loan in the past. If you've had car loans in the past and you go get another car loan, well, then they're going to say, yeah, this guy's already had a car loan. He's paid everything on time. We're going to get him a pretty good score. So it is a little bit of a variance there from purpose to purpose, like credit card versus mortgage. But they'll be generally the same. Credit Karma uses the credit card version of that.
Got it.
So you're always going to get a little bit of a higher score in Credit Karma.
Got it. So it would pretty much be credit cards would be the easiest to apply or to get approved for. Cars would be the next one, and then houses are really kind of that third and most difficult one.
Yep, 100%. Yep. So it's a little bit different, but it's a good guide. It's there to help you. If there's problems or something weird pops up, then you can jump on it and say, wait, this is wrong, or wait, we should fix this, or I made that payment.
Got it.
Call my creditor and that's fixed. So it's really important to understand what your credit looks like, at least generally.
Got it. All right, well, let's go to number 5, which is don't close or open any new accounts.
Yeah, so that's big. So a lot of times people will say, and I would also like to add to that, don't take your balance to zero. So if you close an account and it has like a 7-year history, that's helping you. You know, length of time that you've had credit is an important piece to the puzzle, which is your credit score. So by closing something doesn't actually help you. So a lot of people think, well, if I go close out all my accounts and I have zero debt, it's going to help me. That is not the case. When you open a new account, it's a brand new account. And those people that are reporting that account, they don't know if you're good at paying your bills or bad at paying your bills. Typically, your score will go down a little bit if you open up a new account. And so it's important, and it'll wait until you've established a payment history with them, and they'll say, oh, okay, this guy's all right. And then you'll go right back up. But that takes a few months. Closing something that's old doesn't help you. It's negative because you're getting rid of all that extra history. Because your credit report will actually say your longest account that you've had with these people has been 7 years. And you're like, yes. Well, if you close that and you just open something else, now your longest history account is like a month old. It doesn't look as good. So don't close anything. Don't open anything. And then always go back to option, you know, like kind of, you know, our scenario one, you know, where that first step, talk to your loan officer, call me, ask me if you should be doing something like that. Opening new accounts could be a lot of things. It could be opening a new bank accounts. That can actually cause an issue when you go to buy, because we have to have your account open for over 30 days. And we have to be able to show statements for that account for 30 days. But if you're trying to get in contract on something, we don't have that kind of time. So there's just so many different things. So don't close anything, don't open anything from a credit standpoint or a banking standpoint. Financially, just don't do it. It's a big no-no.
Got it. And correct me if I'm wrong, this also applies to, let's say, like a Nordstrom's credit card, a TJ Maxx credit card. Is that correct?
100%. Yep. Any sort of consumer debts and things like that. And also, you know, kind of along those lines, is don't pay everything to zero. Because what happens is the credit bureaus, they don't care how much money you're spending on your credit cards. They don't care how much. So somebody that's spending $5,000 a month on their credit cards and paying it off every month will get the same out of their credit for somebody that's putting $15 on their credit report and paying it off every month. What they're looking for is the act that you're doing. You're borrowing and you're repaying. You're borrowing, repaying, borrowing, repaying. If you pay everything off and you stop borrowing, your borrow repay history gets less and less and less, and your scores can actually dip.
Okay.
So I always encourage my clients, you know, like use one card for gas, one card for groceries, and then you're always using them. So people that don't like to carry debt, it's still important that you carry debt. But it doesn't have to be a significant amount, you know? They're just looking at the act that you are good at borrowing and you're good at paying it back. They don't care the dollar amount. And so that's a big misconception. People think, oh, I got to carry these balances on my card, or, oh, I got to keep it at zero. Both of those things aren't good. Keeping a high balance isn't good, and paying it off and letting it just sit at zero isn't great either. So there is a balance there. But yeah, kind of a weird nuance that we deal with.
Well, speaking of putting $500 on your credit card, let's go to number 6, which is don't make any large purchases.
Yes. So, and this kind of goes back to kind of some of those first few steps, right, in this process. Large purchases. Well, if you say, Stephen, I've got 15 grand to spend, and then you go out and you spend some of that, well, guess what? You just went backwards, right? You might, let's just say I said you needed 15 and you saved 17. And you say, well, I've got a couple $1,000s there we can go spend. Well, what if you find a house that's a little bit more expensive and you don't need 15 grand anymore, you need 16 grand. Well, you might have just spent that. And now you've got to wait however many months to save that back up. So I always say, just kind of stop your large purchases, keep that money in your bank, really start that savings, really focus on that. And large purchases could also be appliances or a new car or, you know, going on a really expensive vacation, things like that, where you can finance some of those things. Don't do that, right? And it could be a big purchase on your credit card, right? So your credit card balance, you know, might have been really low and now all of a sudden it's really high. Well, that can actually have an effect on your credit. So there's so much. So I would just say avoid large purchases, whether they're cash, whether they're finance, whether you're opening a new thing. All of those things can negatively affect you. So make sure before you do something like that, you go back to stage 1, right? Which is talk to your loan officer, have that conversation before doing something like that.
Right. And, you know, it's interesting because we have for our buyers, you know, this conversation is up into essentially pre-approval to where we can go shopping for a home together. But even after that, when you get into contract, you get an offer accepted, we have a handout to a lot of our buyers, do's and don'ts, Because a lot of people will say, I'm excited about my new house, but I don't have anything to put into it. So I want to go buy a new dining table. I want to go buy a new TV to fit that big wall that I have now. I want to go get some sort of, whatever accessory or appliance it is. And in that process, it kind of throws off the numbers, right?
Yeah, it totally does. So, and we always tell people, once you do get into contract on a house, this is kind of a little bit further on in the process, but once you do get into contract, it still doesn't give you the green light to go out and do those things, because you actually could negatively affect things. I'll get a notification if you went out to Home Depot and applied for a new refrigerator for that new house. It could negatively affect your transaction, and it could cause a potential decline. So not that don't make any large purchases or expenses before you buy, and also during the process. Wait till that process is over, you've got your keys in your hand, and then you can start doing things like that.
Got it. Okay, so we're all lined out now. Let's go to number 7, which is apply for a loan at thebowdonteam.com.
Yep. So kind of once we've had that initial conversation, and I have a lot of these conversations and road mapping, which I like to use. We've done step 1. I put you on a savings plan. We kind of created a budget for you in terms of what you're comfortable with spending on a monthly basis. We've started monitoring your credit, and we've done all of those things. And we fast forward, and we're 6 months later, and you're like, Steven, I've done all of these things that you've asked. I feel like we've been really solid at doing this. What's my next step? And that next step really is just applying for a loan. Once that comes through, it only takes us about less than 24 hours to have that done for you. So like today, like this morning, if you were to fill that out this morning, I would probably have your pre-approval done by the end of the day. If you did it tonight, I'd have it done by tomorrow. So that approval process is actually very quick. Not with everybody, but with us, it's very quick. At that same time of doing that pre-approval, we're going to give you a breakdown of what that approval looks like. We're going to go through, we're going to say, here's the amount that you applied for on that home. Here's how much your max is. So you might have applied for a $300,000 mortgage. We're going to tell you could go up to $400,000. We're going to break down what your credit ended up coming in like. We're just going to give you a nice little kind of just a breakdown of your approval. We're also at the same time going to send you a list of documentation we're going to need. That kind of jumps into process number 8, right? So it's applying for the loan is first. And that stuff all kind of happens very quickly in a short window of time. So applying for the loan is that step number 7. That step number 8 is sending us your documents. And that all kind of goes hand in hand in that first like 24 to 48 hours. Happens pretty quick. A lot of people think that to get pre-approved for a loan, it's going to take days and days and days. It doesn't. It can sometimes be the same day that you've applied. So it's not this long drawn out process. Knowing it's so quick is why it's so important, because that process is so fast, why it's so important to really take to heart all those first steps in this segment, because that stuff's really important. And that might take 6 or 8 months to get you where you need to be. The application's a day. And so, and then from there, we coordinate with the realtor. After you've done the application, you've sent us your documents, your pay stubs and your W-2s and things like that. We round back to your realtor, give them kind of what your price point's going to be, and then you have a jumping off point when you start going and seeing homes in terms of price points and things like that.
Gotcha. So what specifically are those documents that we'll need to provide to you?
Yeah, so and it's funny because a lot of times clients will say, well, you send me your generic list. Well, we have a 3-page list of documents needed, 3 pages. Not every client needs all 3 pages, right? You have self-employed borrowers. We need lots of tax returns for those people. We have W-2 borrowers. We don't need lots of tax returns for them. Every person is going to be unique to their specific scenario. Your standard documentation is a driver's license, pay stubs, bank statements, and W-2s. You're self-employed, we start adding to that. If you're a veteran, we start adding to that. So every client's going to be a little bit unique, but definitely make sure you have your financial statements available. One big hint on there, I guess a tip on there would be, don't go transferring money all over the place. Oh, I'm going to be buying a house and I have 17 accounts. I'm going to start moving money all over here and here and here. It is a logistical nightmare for you. So keeping your money, and that kind of goes with almost with number 6, don't make any large purchases. It's also don't move your money all over the place, right? Don't take money from here and put it here and put it here and put it here, put it here, because we will follow that paper trail all over the place. Most of the pain that people will feel during that document collecting phase isn't a pay stub. I mean, how easy is that to get? It's not a bank statement. You can get it online from your cell phone. It's asset statements. And you would think, oh yeah, I'll just give you 2 bank statements. But if you have 17 different accounts and you're moving money from one to the next every other day, and you just like to do that and you're playing a little bit of Monopoly, that can be quite a pain. So try to keep all your money into one spot. If you have time to prep for this purchase, try to get it in one spot, let it sit there for a few months prior to doing the application, which will simplify that documentation process.
Got it. So now we've gone through steps 1 through 8. The final step really is now the buyer, whether first-time buyer or not, they now have this essentially a budget, right? They have an amount that they can afford for a house.
Yep, and they're off to the races.
Got it. And that's where you hook up with a realtor, perhaps me, perhaps someone else. But it's really important to have to do steps 1 through 8 before jumping to step 9. For reason being is because if Steven says, for example, you're approved for $400,000, but you don't know that, and you think, well, I can probably afford $500,000. We go look at $500,000 houses. You're going to be disappointed when we do look at $400,000. You're going to be disappointed when you find out you can't afford $500,000. But really, it's kind of a waste of your time. It's a waste of my time. And so it's really good from the very beginning to start this process and to kind of build up towards that step 9, which is the fun part, right? Which is going to shop at houses. And that shouldn't be a point of disappointment. That should be an exciting part. So that was our steps 1 through 9 in terms of getting your financing, get you set up to buy a home for a first-time home buyer. Before we get to our example buyer, let's go through some common misconceptions, because I know there's quite a few of them, and this is kind of an integral part of going beyond the water cooler conversations. So tell me some misconceptions, Stephen.
Yeah, so there's lots of misconceptions. So what keeps a lot of people from applying for loans is they have these preconceived notions of certain rules that have been in place that might have been in place 15 years ago, right? Sometimes you'll click on a Google article or something on Google and you'll realize that article is 10 years old. Or you might not realize it. And then you send it to me and I look at it and I say, well, I'm sorry, that was from 2012 or, something like that. So many misconceptions. You'll also have family members that bought a home 7 or 8 years ago, or an aunt or an uncle bought a house 15 years ago. And all these people are going to be giving you advice from all over the place. And they're saying, well, you can't do that. And you can't do that. So there's a ton of misconceptions flying around there about what you can and can't do on financing. One of the first ones, and it's surprising to me because there's so much information out there about our world that I'm surprised it's so misconception, but these things come up every day. So that's why I put, 4 or 5 different things together here. First one is you have to have perfect credit. You have to have a 740 score or better, or even 700. People always say 700 a lot. A 700 or better credit score to be able to buy a house. That's not true. We can go as low as a 620 credit score. So that's a big drastic difference, right? So we might have somebody, and I talk to at least 1 or 2 people a week that think that they need a 700 credit score. That is a huge misconception. You don't need a 740 credit score. We can go as low as 620. And every borrower is going to be a little different. It depends on why you're at 620. Have you fixed things? Are things repaired? Going back to step 1, talking to me, telling me where you're at, road mapping. If you are at a 610, that's okay. We're going to road map it, right? That you're going to be that 6-month buyer. Or you might say, well, shoot, I haven't called anybody at all this whole time, and I've been at 680 because I thought for some reason I needed 700. And you mean I could buy a house today? Yeah, you could. So 620 is one of those numbers to kind of look at. That's a huge misconception is credit.
And that misconception will keep someone from starting the process, from starting step 1. Whereas if they had just gone to step 1, they would have been able to circumnavigate that misconception.
Yeah, no, absolutely. Yeah. And that's why I always encourage people, like, we don't have to pull your credit when you call me. We don't have to make you fill out a big old loan application. You call and just inquire. And we can help get rid of some of these misconceptions. And I think just these conversations like you and I are having right now with this video is super important to get it out there. Like, if you are at that place, that's when we're putting you on that roadmap.
Yeah.
And a lot of times people are just surprised they're already fit the guidelines. They can already do something and they had no idea they could because of those misconceptions. Along those lines, the other one of the big misconceptions is down payment. So people are like, I got to have 20% down. Some clients they totally know you don't. Like, oh no, you don't need 20% down. I had a couple friends. Well, other people might, and so you need 20% down. You don't need 20% down. If you're a first-time home buyer, conventional loans are as little as 3% down. FHA loans are 3.5% down. And so you have multiple different programs out there that are really low, and you don't need a perfect score. And that's where kind of misconception 1 and 2 merge together. Well, I can't do the low down 3% if I don't have a 740 credit score. No, you can. So, another misconception, which is huge, right? Wait, so you're telling me I don't need perfect credit and I don't have to put 20% down? I can do as little as 3% down and my credit score can be in the 600s? Yeah, absolutely. 100%. Another one, and this is a big one, and you'll hear different things from different lenders. You'll sometimes see variances from one lender to another. So I always tell people, get a second opinion. Is you might be told, well, you have to be at the same job for 2 years. And that used to be a rule a long time ago. It is not a rule anymore. So you don't have to be at your same job for 2 years. That's not a requirement. You do need a 2-year employment history. That could be through a couple different jobs. But you don't need to be at the same job for 2 years. You technically only need to be at your same job if you're a W-2 employee for a month. That's it. It's pretty, but some lenders, and that's why I always say get a second opinion, some lenders have a 6-month rule. Some lenders have a 12-month rule. Fannie Mae's rule, and Fannie Mae is the one that governs all of us, they set the base rules for us, is only a month. So you technically only need to be there for a month. You might find a bank that's a little bit more conservative and they want 6 months or 12. That is not the rule. Industry-wise, Fannie Mae-wise, you only need to be at that new employer for a month.
Okay.
For us to be able to do it, which is huge. I get that one a lot. Down payment, I think, is another one. So the down payment money needs to be sitting in your account when you talk to me. Or when we're even pre-approving you. And that is also false. So you don't have to have all your money sitting in your account. It could be coming from a 401k that's not in your account yet. We let you wait until you've actually gotten into contract, passed home inspections, and then you can pull that money out of your 401k. If you're getting a gift from a family member, you don't have to have that money in your bank account today. We wait till you get into contract. We wait until you've passed home inspections. We know this deal is going to go through. Then you can get your gift. So feeling like you have to have all of that money, if you know you have access to it, is the important piece, right? So that goes back to one of those first steps, is knowing what your finances look like in terms of how much money you have, but have it all in one spot, have it all liquid at the time that you're looking at homes isn't necessarily the thing, as long as you have access to it. So that's kind of one of those other ones. But those are kind of the main misconceptions, right? It's down payment, it's credit score, it's you have to be at the same job for a long time, and you have to have all that money sitting in your account. All of those are misconceptions that I think that I see regularly.
Okay, great. Well, thank you for clarifying those. Let's finish this off, Stephen, by taking a look at an example first-time buyer. So having said that, let's introduce everyone to Barb. Barb is a first-time home buyer. Now let's figure out a little bit about Barb. She reaches to Stephen, talks to him about applying for a home loan. She applies online at thebowdonteam.com that very night. Now the next morning, within 24 hours, Stephen approves Barb for a loan and schedules a call with her. So let's go through a little bit of Barb's numbers. Her income, she makes $60,000 annually or $5,000 a month. Her debt is a $300 car payment. She also has a $50 credit card payment and a $150 student loan payment, totaling $500 of debt a month. And her credit score is going to be 685. So that it's going to be below that 700 that a lot of people have locked on. Let's see what Barb can get approved for.
Yeah, no, absolutely. So we kind of talked earlier about, debt to income ratio, right? That's what we're looking at when we're looking at your income. So we're $5,000 monthly income. We're using that number to help qualify her. So the first part is income versus debt. That's your debt to income ratio. So we're looking at Fannie Mae goes up to 50% of your debt to income ratio. So 50% of her $5,000 monthly income is $2,500 a month. Well, she has $500 of outgoing debts. That leaves us with $2,000 that Barb could spend on a house. Well, Barb might not want to spend $2,000, right? And so she might have a kind of a different scenario in her head. But from a debt to income ratio standpoint, Barb could go up to $2,000. So now what we've got to do is try to figure out, okay, well, we know Barb can go up to 2,000. How much money does Barb have saved? Well, Barb has $10,000 in savings, and she has another $5,000 she can pull out in 401k. So now I'm tasked with, okay, well, and also Barb wants a payment of $1,700 a month. And so what we're doing is I'm looking at, okay, what can I do for Barb to get her a $1,700 payment for $15,000 out of pocket? Those are her two comfort zones, right? She's comfortable spending $15,000. She's comfortable with a $1,700 mortgage payment. And so we take those things. I do my, little fairy dust, little magic on it, and then we come up with a purchase price. And so in Barb's case, although she could qualify up to $2,000, but she wants the $1,700 per month, we settled on a first-time home buyer, 3% down program at $300,000. So at $300,000 with 3% down, we only have $9,000 as a down payment. And then roughly about $5,000 to $6,000 in closing costs and property taxes and home insurance, some other things in there like title and escrow fees. So we've got so we're kind of hitting our $15,000 mark that she's comfortable with spending. We're also at the same time hitting her $1,700 payment. So for Barb, based on her income, based on her assets, we're really going to put Barb at that, $300,000 buyer, 3% down, conventional loan, $1,700 payment, $15,000 out of pocket. That's with a rate of about 3.125% today, an APR of about 3.255, and that really gets her starting that process with a jumping off point with you, the realtor. So then after we've had this conversation with Barb, hey, here you go, 300,000, 1,700, 15 grand. You're off to the races with your realtor. You have a scenario. We don't like it to stop there, right? We'll run that initial scenario. We'll have a really good jumping off point, which is huge. It's amazing. She knows it pretty much exactly what she's going to get. What I don't want to do is say this exact scenario is locked in stone if you don't buy for 3 months. Rates change daily. Every single house is going to have different property taxes. So what we do is what we'll do for Barb as she's looking for homes is Barb, when she sees a property that she likes that you sent to her, she's going to send that to me. She's going to use me as a filter. I'm going to run a scenario specific to that property. I'm going to say, hey, Barb, this house is $1,750, and you need $15,500. And the next house might be a little bit different, and the next one might be a little bit different. And so, but at least we have a jumping off point, and this exercise will get us close to our comfort zones. It's important to stick next to your comfort zones once we've established those. So we know Barb is at 1,700. It's really important that we stick close to that. We also stick close to the 15,000. And doing these exercises is how we're going to maintain doing that for Barb as she continues to look for houses.
Absolutely. Well, clearly, too, Barb has done step number 2, which is figure out how much she'd be willing to spend on a monthly basis. Because in terms of shopping, you want to know your full budget as far as the house cost, but you also want to have a good understanding of what that monthly payment is going to be. Because, for example, you're probably going to be looking at it in terms of what they pay in rent right now. So Barb might currently pay $1,500 in rent. So she's comfortable with $1,500. She's making that work right now. And looking at her numbers and looking at her spending, she would be comfortable going up to $1,700. But anything beyond $1,700 might make her a little bit uncomfortable. So that's where kind of doing these other steps along the process are really important in figuring out what you're comfortable with, what you can afford, on top of what you're already, spending as well.
Yep, 100%. Yeah.
So Barb now has the green light with me to go look at places. We now have a good, idea of what we're going to be looking at and why and where, and we can go look at some good options that are a good fit for Barb.
Yep, 100%.
All right, Stephen. Well, that is it. Thank you so much for your time. Thank you for joining us, and we look forward to having you back on for other topics as well.
Thank you so much for having me. Have a great day.
You bet. Be well.